So after yesterday's rebound, things were looking pretty good until I guess the Credit Suisse overseas last night started to weigh on the markets overnight, and fortunately things settled down today, and it wasn't as bad as it could have been. It was a down day, and we are in a bearish trend, but it wasn't as bad as it could be. We still haven't broken significant support, so I'm going to highlight those areas of where significant support is and where maybe the volatility can start to pick up. It was an interesting move in volatility that we haven't seen. I'm going to show you what that was and what it means for our expectations going forward. We'll take a look at what was the main driver. There's some asset classes that had some significant moves today that we haven't seen previously. So I'm going to show you that. We're going to take a look at the sector moves. Obviously, we know the financial sector's been under duress lately. Another sector kind of joined the party. That's where we're going to get our trade idea of the day. It's been a pretty popular area for us to get trades lately. So we'll take a look at another really good opportunity on a little bit longer term basis. I'll set that up for you as well. So that's what we have on the docket today. So let's go ahead and get started. Today is Wednesday, March the 15th, 2023. This is the market outlook from marketscholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right, including our Market Outlook live video. I do at 3:30 Eastern time on these days. I do the Market Outlook. Come down to the bottom, click on this heart, 118 likes. So thank you again, everybody, for the likes. I appreciate it. Again, I've told you before how significant that is for us. It goes a long way on helping us get our content out to all of our followers. That's why we always ask for it. So again, thank you to those who like. And if you click on this thumbs up icon, it brings this tab up and you can like that there. Thank you again for those who like those day in and day out. And those who don't, again, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the market forecast on the S&P 500. As you can see, we had our decline today, though. For the third day in a row, we actually rallied intraday and closed higher than where we opened. So that's not so bad. We've seen that kind of stalled this decline here, where we had a lot of those closes higher than the open. So it kind of stalled that weakness and ended up being a pretty weak intermediate decline there. This is a short time frame of dark pink shading and a red line. So whether that's going to be the case now, because again, we are further below. We did barely get further below that low point, below the 30-day moving average. The intermediate line is well in the reversal zone. What's interesting is market sentiment's actually rising. Now it's been going up and down and up and down and up and down. So I wouldn't put a lot into that word rising there. It's basically been as flat as a pancake, but just below 60 for like this entire time, between 58 and 60. 57 right there, 58, 59, into 60. So it really hasn't gone anywhere this entire time that we've been below the 30-day moving average, even though the intermediate line's been down for quite a while now. So at some point in time, again, if the intermediate line stays down, you would expect it will. And then again, that's where we'll probably end up with a little bit more of a move to the downside like we've seen before that's got market sentiment into the bearish territory each time. So what is standing out to me here is this discrepancy on the momentum in the near-term line. Again, if the near-term line peaks right here, that would be a bearish peak for the near-term line. Getting into bullish territory, not getting in the reversal zone, not getting above 90. But what really stands out is it went further than the momentum line. And that's not a good sign, right? Usually the near-term line follows the momentum line higher. It's not necessarily a good sign for maybe it might do something like this where the momentum line might go up first and then drop down, but it's not good for the near-term line to come up further than the momentum line. It generally doesn't mean that we're as bullish as we think we are. You can see some example here where I actually did lead into this fake out move, which as you can see now has shown to be not as bullish as we thought we were. So we're seeing that again. We're seeing this near-term line again take off, where the momentum line kind of stopped in neutral territory and has rolled over. And at the lows of the day today, that momentum line was well oversold. But the near-term line was actually still above 60, even at the lows of the day today. So the divergence is a lot worse. So it actually wasn't as bad as it was earlier, but still, that's a pretty significant divergence that we don't necessarily want to see. You can see the Dow Jones, kind of very similar thing as well. Its market sentiment line is easily falling, as we are obviously well below the 30-day moving average with we've gotten oversold clusters. So that's what's bringing that market sentiment line down. The intermediate line way below, much more bearish than what we saw in December. Your NASDAQ 100, on the other hand, was actually really bullish today. It rallied, again, 3 days in a row where we rallied, where we closed higher than the open. But for the S&P, those were mostly down days. For the NASDAQ, they were all up days. All three of these were bullish days. So a lot more bullish on the NASDAQ 100. I mean, again, remember the NASDAQ, the Dow is way down, and the NASDAQ's a lot. I mean, it's barely below its moving average. It's still below it, otherwise it'd be green right now. But it's still like it's right at the moving average, only less than 0.25% below the moving average there. Again, another issue with the momentum line getting into bullish territory, but not into oversold levels, not very strong levels. But the near-term line just went to extreme highs. So it's just not necessarily what you'd like to see. You would like to see the momentum line pull the near-term line up. And maybe the near-term line, maybe the momentum line does get up to 100 and the near-term line doesn't quite follow suit. But this is not, like again, something you saw right here. This is not what you want to see. The momentum line falling into bearish levels and the near-term line getting to extreme highs. That's a divergence that typically will lead the near-term line to follow the momentum line, in this case lower. You can see the Russell 2000, again, as bearish as it's been, in fact, it's flirting with those December lows. You can see, again, its near-term line is also rallying, a little bit of divergence, but in this case, neither one of them is in bullish levels, right? They're still, near-term line is barely outside of bearish territory. Market sentiment line's falling. It was a little bit more bullish, but obviously it's a lot more bearish now, 8% below, way below the moving average, way worse than what we saw there. And we obviously know the reasons why. SPX looks like today, really the last few days, has gone down to, excuse me, I do not want to delete that, has gone down to this important 38% level, this important retracement. Again, remember all of these colors are based off of different levels. And 38, you got pretty much between 3840 and 3800, you got all four of these lines. The red line being based off of the March 2009 low, pullback, right? Getting below that line would start the retracement. The black line being the 38% retracement coming off the COVID low. The green line being this 38% retracement of this decline that we have been retracing. So we'd be back below support. And then the 23% line of the correction drop that we've had would get us back in bear. Essentially, getting below 3,800 would not only get you below these December lows, but getting below all of these lines would really be bearish, really be bearish there. So we're still holding on the hope right now that we're not going to do that, but we're knocking on that door. And again, we've already knocked on that door once and it held. Now the question is whether it will hold the second time we come back with obviously a lot more. We didn't have a financial crisis, or at least a banking crisis. I use my quotation marks then, like we do now. So things are a lot, we've got a lot more weight on this decline coming off of a fake out pattern that I told you before was probably way too bullish and way more insidious of a fake out pattern potentially than what we even saw in mid-August. Let's take a look at the long-term chart. You can see we have our death cross. The 10-week is crossed below the 40-week. Strong bearish candle, lower low, easily lower close. PPO is falling. You can see the differential, Akinyashi differential, is well below its moving average. So pretty bearish from that perspective. We do have green arrows on the NASDAQ. So the NASDAQ got a green arrow on the stochastics yesterday and MACD today. Everything else, though, is we're not near. The S&P is closest to the stochastics, but we're not near green arrows on any of these others. So we're still in intermediate declines on all of these. It's just the NASDAQ's been able to hold up really well. These FANG names, again, acting as safe havens like they've done in the past. Here's the S&P broken down. You can see we are below the 200-day moving average. We are still below the 8-day moving average. So we get these old rallies because we're so far at the lows of the day. We're so far below very short-term moving averages. It's hard to extend too far away from them without coming back up. and that's kind of what we're doing. But again, the 8s crossed below the 200, the 17, they both crossed below the 50. They've already crossed below the 30. They both crossed below the 50, and now you're flirting with them crossing below the 200. Like, we are below the point of control. I mean, as bullish as it not is nice to get off those lows, but we are definitely, and look at all the volume here, we are definitely not necessarily out of the woods. And you can see from a weekly chart perspective, we are still below the 30 week that we had broken below last week. Broke below all three of these last week, and the 50. And your 8-day is just, I mean, the MACD is just crossed below its moving average, same with the stochastics. Neither one of them are in bearish levels yet. They're still sitting right at the midpoint. So, if we were to stay below these, and then, like I said, get below this 3,800 level, 380 in SPY, then you can see how much more bearish we can actually get on a long-term basis. Now let's take a look at some of these other oscillators first. Let's look at the DMI. You can see, again, bearish levels below 20 on the positive indicator, above 33 on the negative, so that's why your ADX is rising. Dark pink shading in a red line. So we do have an increasingly strong bearish trend. We're below the cloud. We have a negative rate of change over 26 days. The green, we're below the green and the blue lines. The green's below the blue. The green's below the cloud. You can see we have a weak trend still going below -1. Still below 65. So once you clear those, the -2.5, or the -2 level and the 65 level, now we have an intermediate trend strength. And you can see we've had, every one of these declines have gotten up to that level of strength to the downside. So that's kind of where we're at right now. On that, of course, we are easily in the lower level of the 4-week range, still below the moving average down there as it's moving lower. The RSI and the CCI are also at bearish levels, below 0, below 50. So neither one of them are moving up to bullish levels yet. Looking at the McClellan oscillator still remains really strongly negative. So the summation index has easily cleared the 0 level and is working to the downside. This is a very broad sell-off. You can also see the money flow, and the money flow index is at its lows of the year. Again, lots of volume. Easily in bearish levels here, lots of volume to the downside, and not so extreme though that we can't keep going to the downside. We are in the lower quartile still, but this at the top end, so we're still at bearish levels. We're above the Keltner channel. The bands are outside the Keltner channel, so you have some green dots and declining momentum. So we'll see if we end up picking up momentum, or if we work our way towards some blue bars here, some positive momentum. But as of right now, again, you'd have to get at least up into the upper quartile for that to happen. At least up in the upper half of the chart, much less the upper quartile. And of course, that doesn't look to be the case right now. Looking at the 4-week range, we finished above yesterday's low. We worked through a good chunk of today's gap. We didn't quite fill in all of the gap, but we filled in a good chunk of today's gap there and closed above yesterday's low point. Lower high, lower low, but not as bearish as it could have been. And we never did clear last week's low point. We did very briefly at the beginning of the week. We got right back above and then have been above. So watch that level on an intraday basis, which is now pretty much today's low point. Tomorrow, if we break down and break out of the value area and break below those levels, but you can see we can also move up towards some volume, because there's not a lot of volume in here before we do that. And we might be able to fill in the rest of this gap before we ultimately turn back down. Of course, we did not get a new 4-week low point, so the red line is declining. We have to get all the way, like this has to move over some days for us to get the red line below 70. And that's when we're at the risk of a reversal, in this case to the upside. But I would venture to guess we probably won't get that until we get the price channel up above 10%, up closer towards 12.5% or higher. I don't think this will be an intermediate decline as shallow as what we saw in December. I think it'll be more like some of the others that we saw in 2022. Your VIX is jumping up a lot higher. Again, we haven't seen the VIX be this high in a while. It's been, again, since September, October. So you did not get this high in December. So we are at 64. We're getting a lot of long upper shadows. We're not holding, but you can see, like, what really stood out to me today was the VVIX closed really, really high. Like, we haven't been up here since April and May. This is a higher VVIX level than what we saw in August, coming off the August peak at the October lows. So volatility is expected to ramp up pretty significantly here with what the VVIX is telling us. We're not there yet, and part of the reason you saw in a tweet that I put out there, here, let me bring this up so you can see it. Why is the VIX not able to get above this 100% mark? Well, there's a reason why, and that reason is that the VIX is not the only thing that's trading, right? The VIX, the reason why it can't get up to really high levels, I mean, it's at the 30, it's relatively high compared to what we've seen. But if you notice, the implied volatility for these options on SPX is the same at 30 days out, roughly, as it is at 275 days out. So that's not normal. And that's why we're not seeing a washout. That's why I expect we'll see more bearishness, because there's just as much volatility 300 days from now, expected volatility, as there is 30 days from now. And again, if you want to see a typical washout pattern in a correction phase where we do jump above 100% and we jump above 125%, this is what the options chain looks like in that scenario. The 30 days out is a lot higher, it was around 36 when it was right at 30, compared to 300 days out when you're in the mid-20s. That's typical. That's a washout, and that's not what we're seeing right now, which tells me we're not getting a washout right now. Even though we're close to 30, we're not getting a washout right now, and I expect that we'll see, a continuation. You saw my tweet last night, because this got a lot of traction last night. For those of you who follow me on Twitter, if you don't follow me, you should follow me on Twitter, because I put stuff like this out there. But the skew spiked up yesterday, and you can see all the other spikes I've highlighted, and the blue arrows tell us what the markets have done after all those spikes, right? The blue arrows. Every time we spiked in the MACD to above 1.5% or close to 2, then the blue arrows is what happens on the S&P afterwards. And so here's our spike, and you can kind of see this is where the VIX was on each one of those levels. The VIX, 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 VIX. All of those led to rallies in the volatility. And I think we're at a higher level now. We have a higher VVIX now, which means we may get a higher move on volatility than what we've seen so far in this correction phase, which more likely means that we are transitioning from being just a correction, not a bear market, right? Because we're still easily above the 200-week moving average. But I think we're transitioning from being above just a correction to a move to and through the 200-week moving average that does transition us into an actual bear market for 1973. And as I also mentioned too, that by itself does not necessarily mean that we that we are done, right? That will break inflation, because as you see, if you go back to the inflation levels back in the mid-70s, the real Fed funds rate, here is the real Fed funds rate. In 73, 74, it dropped just like it's doing now, but then we rallied in the mid-70s, but we stopped raising rates before, we had that recession of 73, 74, and you notice that we stopped raising rates before the real Fed funds rate went positive. And so here's 73, 74, what inflation did, and we brought it back down with those rate hikes, but we stopped too early, and the recession couldn't get it back down to 2%. In fact, it brought it, we just got back up and got worse. So recession in and of itself won't necessarily be, I would not be surprised. I know the odds are now relatively 50-50 that the Fed will raise rates here next week. But I wouldn't be surprised if they did, because again, the real Fed funds rate is not positive. It's not even close to being positive. It's still like 140 basis points negative. And there's still room for them to keep it higher to get those year-over-year CPI rates lower, especially at the core level, because you see the core level is expected to be higher next month. At the next reading, the core level is actually expected to be higher than it is this month, and you can see that on the PCE too. So there's still a lot of work to be done, which is why I wouldn't be surprised if we don't. I know for May, it is only a 31% chance that we'll get a rate hike in March and then another rate hike in May. So very low odds compared to an 80. We were at 87% odds a week ago of being at 5.5% here in May instead of just at 5.25, which means one of these is going to be a 50 basis point hike. So things have changed, but they haven't changed enough to where, again, the Fed needs to stop worrying about inflation, because if they do, then we are definitely headed towards, because it's another jump in inflation, this time with the markets, below moving averages, is not what anybody wants to see, for sure. All right, now let's take a look at what's driving a lot of this price action. So let's bring up this asset class comparison chart, and we'll take a look at. You can see the 3-month returns are now pretty broadly negative for all the equity asset class. In fact, the only thing that's up over the past 3 months are the Qs, from an equity standpoint, and then gold and the dollar. So I mean, that's about as risk off as you can be to only have gold and the dollar up over a certain period of time. Let's look at just today alone. So here's how things performed today. As again, we started off with this financial crisis, right, with yields way down, bonds up higher, gold up, the dollar was up pretty sharply because a lot of the weakness from the banking problems were now overseas in Europe with the Swiss National Bank, and you can see the Qs ended up rallying and ended up on the day, whereas developed markets, especially where Europe is a main part. And they have been so overbought, right? Those areas. If you look at the European areas here, the European areas on this relative strength chart here. If I were to go to EWA and look at all the developed markets, again, let's put them relative to like a global ETF that tracks everything. You can see they had all been up to the right. Now they're all moving down to the left. You can see Spain and France and Austria and Italy and Germany. I mean, they have strong relative strength. They're way over here on the right in relative strength, but they're just starting to lose momentum to the downside, so they're all moving sharply. Japan's not as much, but there's Switzerland also moving down to the left. They're the ones getting hit the hardest. This is on a long-term basis. From a weekly standpoint, here's where they are on the weekly chart, and you can see, again, down to the left. Very, very significantly down to the left here. So developed markets are really taking a turn to the downside where they have been so strong. You look at it on this chart. Let's look at EFA here. EFA, where with a lot of those stocks are involved, and compare that to that same VT chart. They have been doing very well. So on a weekly chart, very strong relative strength, and now starting to lose it. And they've got a lot of room to come. They had been underperforming for so long, so this is kind of a rare thing to see them doing so well. But now not. Now not doing so well. As you can see, here is the what that ratio, what that relative strength line looks like on this chart, breaking below multiple moving averages. Remember, this also has an impact. If we want to see just how big of a quote-unquote credit event this is, then you look at these high yields, and they're well down below the 200-day moving average relative to IEI. Big drop in momentum, very, very strong, as we've seen in the past in 2022. But this time, unlike over here, where we were a lot closer to zero, we're just starting a decline, right? The PPO is just turning down. The DMI, the negative indicator, way up, but we haven't seen that this high. We are well below 40 here. Like, we are in bearish levels on this credit spread between corporates and treasuries. So which is basically about as risk-off pattern as you can have right now. So things are definitely moving to the downside. And of course, not surprising that we see the main sector that we see pushing us down is the financial sector. The 3-month returns is now down at the bottom. And you can see XLK, XLY, XLC up at the top, right? Those are the Qs, right? Those are typically correlated with the Qs. Looking at just today alone, so here is March 15th, looking at just today alone here, you can see that, again, XLI, we talked about this in our last market outlook, XLI, XLB, XLF, XLE, all the biggest losers, right? This is that cyclical part that is underperforming the markets. XLY, C, and K are outperforming along with your safe havens because they're acting like safe havens. But this area, which had been so bullish during this little bullish move off those October lows, right? If I were to go all the way back to that October 13th low point, they have been your biggest winners. Here, let's change that. Let's change that to a couple hours. They had been your biggest winners off those mid-October lows, You can see a lot of them, but they're now starting to come back. Especially look at energy really breaking down here, well below those October lows. Now it's the first sector to drop below those October lows. We'll talk about that more here in just a minute. But let's look at, since this whole financial thing became an issue, again, starting at that March 7th move to the downside, you can see that, again, financials and now energy is joining the party. Materials and energy, or industrial, excuse me, all this really struggling. Whereas utilities are up over that time frame, staples are close to being up, and technology communication services are down less than 1%. Discretionary down about 3%, so a little bit more. Real estate kind of getting pulled along because it's been hit by a lot of these problems too, from a risk appetite standpoint. So not your typical risk off move because you're not being led down by these big cat names. They will eventually lead our way lower. So as I've told everybody, until we get to those October lows, these are the areas of the market I expect to be more bearish. Once we get through those October lows, then I expect XOK, XOY, XOC to really break down hard. The Apples, the Teslas, and those stocks. Those stocks of the world will lead us back down. But until then, until we get to those lows, because remember the Dow has rallied so much that this is the area of the market that's probably not the best to be in, obviously, right now. All right, speaking of the energy sector, that's where I want to look for our trade idea of the day. So let's take a look at Occidental Petroleum. I know we've done some others on Chevron and Halliburton. But you can see Occidental really breaking down pretty hard today, breaking through. If you look at my cursor all the way to the left, closing above the September lows, closing near the August lows, just a little bit below those August lows, kind of flirting with those June, July lows, really like kind of towards the low end of the year, on a closing basis especially. Down 7% below the moving average after failing to getting up to the moving average, failing there and bouncing back down below that cluster low point. Today closing below that cluster low for the first time. That's significant. Looking at its long-term moving average here, you can see that we are just starting a death cross after being in a golden cross environment for quite a while, and trading below the 40-week and looking like we might be able to kind of turn this around the last couple of weeks, but failing. Like we got the higher close, we got the transition candle, but we didn't close above the body, and then boom, back down below that close. It means we're back to being bearish. And like I said, with the new death cross here that we haven't had in a while. Let me go back to the market forecast and show you what the weekly market forecast looks like for Occidental. And you can see it's just turning dark pink shading in a red line after having really significant move higher on the off of those post-COVID lows that we have. We dropped down sharply, retested those lows, and then really bounced back up relatively sharply there. Looking at the 3 green arrow chart for Occidental, you can see that we are below the point of control on the 1-year chart, well below these moving averages. They're all falling. The 30's below the 50. They're all below the 200. Here's what it looks like on the weekly chart. We're just getting below, the 8 and 17, just getting below the 50. They're all turning lower. And you can see this value area and point of control here on the daily chart. It's lined up with this volume node. If we get below, there's just nothing down here. The 200-week moving average is there, but you can see that doesn't look like it's got a lot of. It might break the fall a little bit, but it doesn't really get a significant layer of support until you're down into this 28 level. So things can really turn dicey on Occidental relatively quickly, especially with how bearish things have gotten here. You look at the Keltner channels for Occidental, you can see we are breaking below the lower band. Again, close to breaking below the Keltner channel. The bands have just barely gotten inside the Keltner channels, and now we're breaking back out of them. When you look at like the DMI for Occidental, you can see that we're above 30. We're almost breaking below 20. On the weekly chart, you can see we're just breaking and barely getting above 20 with the positive way down. So the ADX is at a low level on the daily chart too, but now the ADX on the weekly chart is really low level. So we're setting up for the beginnings of a move to the upside. Here's the dropping well below minus 150, dropping below 40 again on the daily RSI and CCI. But look at the weekly. Like we are in bearish levels, and we're that close to starting to validate these bearish levels here. Looking at the Ichimoku cloud, we are easily below the cloud. Very bearish, 26-day rate of change. We got an intermediate trend strength that is not mature, but on the weekly, we're just barely starting a weak bearish trend. Barely starting a weak bearish trend, and into the cloud, and just a barely negative 26-week rate of change. So on a long term, on the short term basis, we're pretty bearish. Not extremely oversold that we have to bounce, but we're definitely entrenched in the bearish trend. But on the weekly chart, we're just getting started on more of a longer term decline, potentially. So what I decided to do here is say, okay, well, let's take a look at the buying a put a little bit further out, 93 days out, buying the at-the-money put, and going, putting my stop order at 50% of that. So I can get rid of this here. 50% of that. So my at maximum loss, we'd pay $1,000 risk, which is my normal risk for a trade. But the stop order cuts that in half and puts it more of my directional risk. And I was kind of showing here in the Market Outlook Live, if we did get to 1 standard deviation, you're looking at about a 4-to-1 reward to risk ratio at that $500 risk level. Of course, if it does break down further, as you saw, it very easily could, into this area, into the high 20s, low 30s, then you're looking at an 8-to-1. So things can really pick up the pace to the downside, especially as you see commodities are breaking down, which they don't do in bull markets, right? And crude oil especially is close to breaking below its 200-week moving average. This is a big breakdown below lots of, we were converging for so long, but now breaking below all these lows. That's a very, very significant break on crude oil and could have some very significant ramifications, right? If we were to get lower, like we're already down to the last November lows before the Ukraine invasion. We're way down on the crude level basis down to those lows. Again, that's not that's great for an inflation level, but it's actually deflationary, not just disinflationary. Now it's more deflationary and a reflection of an economy that's just not needing it, right? Which means an economy that's not growing. And so we're going to try to take advantage of it with this bearish trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between the videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join our website at marketscholars.com for free. Like us and follow us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.